If you're a non-technical founder spending your days on co-founder matching, stop, close the tab, delete your profile, cancel every single coffee chat on your calendar. And look, I get it. You're just following the rules of the startup game. Every accelerator, every VC, every startup guru will tell you the same thing. You need a technical co-founder if you're going to succeed. But here's the dirty secret no one will say out loud. That rule was never designed to make your startup do better. It was designed to make their job easier. Here's what's actually going on. There's a story about a legendary high-end steakhouse chain that hit a wall. They could cook a steak to perfection, crusty sear, pink center, every single time. But there was a problem. It required a master chef to pull it off, because every cut of meat that came in the door was different. It had a different thickness, different marbling, different fat caps, and a master chef could easily read the meat and adjust. A line cook, they would destroy it. So the steakhouse went back to their suppliers, the butchers, and made them an offer. Give us perfectly uniform cuts, identical thickness, identical weight, identical fat distribution. Do that and we'll pay you a premium. And the butchers agreed. And suddenly, the steakhouse didn't need master chefs anymore. They could hand that same steak to a minimum wage line cook, give them a timer and a temperature, and it worked. Same perfect result, every time at scale. Now, the startup and VC world operate on that exact same principle, except in that game, you are the meat. They need you to show up as a standard cut. Technical co-founder? Check. 50-50 equity split? Check. Two 22-year-old Stanford grads in a garage? Check. Not because that structure guarantees your success, but so a 26-year-old junior associate can evaluate and eliminate your company using a checklist, instead of a senior partner having to actually think before they make a decision. So right now, you're contorting yourself, burning months, giving away equity, trying to fit yourself into a processing machine that isn't even looking at your potential. In this video, I'm going to show you how to stop being the meat and start being the chef. And if you stick around to the end, I'll give you the playbook non-technical founders are using right now to launch their startups without waiting for a unicorn co-founder to fall into their lap. Now let's dive in. The wrong game. While you search, your competitors ship. Let's talk about the co-founder search. It certainly feels productive on the surface, but underneath, it's not really that productive at all. So what happens is, it really just becomes sophisticated procrastination. While you wait, your competitors are shipping product. And you keep having these false starts where you seem to have great conversations and looks like you're going to find a great co-founder this week, but then nothing happens of it and then you have to restart next week. And again, meanwhile, your competitors are shipping product. And they're launching ugly MVPs. So you look at what they launch and obviously you're laughing, but they're getting feedback. They're iterating fast. They're gaining speed and they're gaining momentum. And at the end of the day, for you, the choice you're making is stagnation or momentum. Playing the lottery. Let's talk about the dirty secrets of the VC and accelerator game. So Y Combinator accepts about 1% to 2% of the approximately 30,000 applicants that apply to every one of their batches. Now, they have a lot of rules, right? Many of these unwritten, many of these shared throughout the startup community. You have to have the right co-founder. You have to have the right location. You got to be in Silicon Valley, ideally. You've got to have the right pedigrees. Lots and lots and lots of these rules that you need to have for you to, quote unquote, get into that batch. But the question is, are these rules all wisdom designed to make you succeed? Or are they triage to make it easier for them to select who those applicants are going to be for the next batch? You might spend 3 to 6 or 9 months or more working to try and find a co-founder, because again, that's one of the rules. And during that process, if you happen to find a co-founder, you're going to give up 40 to 50% of equity in your startup. And all of this for a lottery ticket, for a 1% to 2% chance of making that batch or getting that VC investment. So let's talk about the obedience loop. What's going on here? So there's a rule, you must have a technical co-founder. Now, so great. So you create profiles, you send DMs, you set as many conversations and meetings as you can with potential technical co-founders. You pitch engineers over coffee, and you make them a generous offer. Co-founder title and 40 to 50% equity in your startup venture, which obviously is going to be a great thing. And of course, the standard 4-year vesting with a 1-year cliff. So this is a great deal. And so you sit there and you wait for takers, and all you get is crickets. So why non-technical co-founders are getting ghosted, misled, and left behind? What's going on here? Well, here's the reality of what's happening during this co-founder process. Technical co-founders love the attention. So when you go to these co-founder matching platforms, you're going to find technical co-founders, and you're probably going to get a bunch of meetings with them because obviously they want to be wooed. They want to be told that they should join your startup. But they hate the risk. And here's why. A lot of these technical founders are making $250,000 to $350,000 or more at a large FANG or other hot tech startup. So that's pretty stable, and that's got a lot of status and prestige already. And now the thing that you're offering them, your generous offer, is $0 per month plus upside, maybe. For them, the math doesn't really math. And for you, you just get stuck waiting forever as you have these false starts, as they listen to your idea and they love your idea. And so they say, sure, I'll do it. Then they wake up the next day and they say, what am I doing? I'm not going to walk away and take on this huge risk. So this is the co-founder trap. And I've talked to dozens and dozens of co-founders, non-technical, who continue to have these false starts, have these great conversations with technical co-founders, many of them agreeing to be a CTO and even starting to go down the path, only to ghost them later on when they realize they've gotten into something that just doesn't make sense from their perspective, from a math perspective. So how do you escape this trap? And how do you take back control? Well, so the key is to go into your circle of influence, right? Rather than waiting for that perfect unicorn technical co-founder to show up, you need to stop following the rules. You need to stop waiting for permission to move forward on your startup. And you need to start building proof. So you've got this vision in your head where you know that you've got an idea that's going to completely transform your industry. You need to start building proof that that's the case. Don't necessarily find a co-founder, or certainly don't wait for a co-founder to do that. You need to become so undeniable that a co-founder finds you. So do whatever it takes to move forward. Take your resources, whatever resources you have, and apply those resources into getting momentum, into getting things off the ground, into getting feedback, into iterating, into moving forward until things go and then people want to join you on your quest. The rule here, the actual rule here, is that momentum creates options. Now let's talk about the outsourcing taboo. This is another rule that you'll see a lot of startups are being told. You should never pay for your core product. Why you should never outsource your core product? Well, investors won't fund you if you didn't write the code yourself, or at least that's what they say. And most startups that outsource their MVP end in failure. Now, of course, the dirty little secret that they won't tell you is that most startups that insource their MVP also end in failure. The reality is startups are extremely hard. Most startups fail. That's just the reality of the game. So if you're in the game and you're in it to win, you have to accept that and you have to focus on everything you can to make it work. And the key is that the only thing that matters is clarity of vision. You know where you want to go, and then focused execution. So keeping that control the entire way and then using that to move forward. So let's talk about why this never outsource rule is just a lot of BS dogma. So the reality is investors fund traction. Investors fund fear of missing out. So if you talk to an investor and they tell themselves, I better not miss this, that's what matters. That's what investors lose sleep at night over. They write lots and lots and lots of checks that go to zero. They lose their money on investments all the time. That's not the thing that keeps them up at night. The thing that keeps them up at night is that one idea that they were given that turned into be a massive idea that they passed on. That's something that's unforgivable from their perspective. So for you, you need to be able to create that FOMO that's going to make investors want to fund you. So they don't care who actually wrote the code. Unless, of course, you lack traction and FOMO, in which case they'll give you all sorts of excuses about why they don't want to invest in you. So the reality is product and users and traction are what matter. Everything else is theater. So let's talk about the real math. Free co-founder versus paid launch, which are two viable options. So option A, we'll call that the standard cut. This is the co-founder search. I'm a non-technical co-founder. I'm going to go find my technical co-founder and launch from there. Option B, we'll call that the chef. This is you take action now. You don't wait for a co-founder to fall into your lap, and maybe you find an agency or studio and you get building immediately. So option A in the co-founder search, well, the cash cost is zero. So it doesn't cost you any dollars to go find a co-founder. The cash cost of being the chef or finding an agency or dev model, that's definitely going to cost you something. That's not going to be cheap. That's going to be an investment in your idea, in your vision. Maybe that's somewhere market rate, $15,000, $25,000 per month as you move down your MVP. That's definitely going to cost you some cash. But let's go back to that standard cut. What's that going to cost you in equity? Well, that's going to cost you 40 to 50% if you find that co-founder who's willing to join you on your journey, right? The equity cost for doing it yourself and going through an agency or a studio, anywhere between 0 and 10%, but depending on what arrangement you make with that studio. On the standard cut, the time spent, well, it's gonna take you a long time. This could be 6 months, 9 months, 12 months, searching, thinking that you've got momentum and then being stalled, going back to square one, trying to find a new co-founder. This can take you a long time before you even get out of the starting gate. And in option B, the time spent will be 6 to 12 weeks building. So on day one, you're going to start ideating, you're going to start throwing ideas down there, you're going to distilling those ideas into actionable plans, and you're going to get building, and you're going to get something into market very quickly. On the standard cut option, so what happens to control of your venture? Well, obviously, when you give away 40 to 50% equity, you're going to have a split in terms of control. So you better trust your co-founder. It's going to be whatever you negotiate with your co-founder is going to be how that control plays out. In option B, the control is going to remain 100% yours. So in option A, let's talk about what happens to the dependency in terms of what happens if your co-founder doesn't work out. You've got a lot of risk there in terms of relationship risk, especially if it's someone that you just met, someone you don't know, someone you don't necessarily trust. There's a lot of potential for that to fail. On option B, the dependency is pretty low. It's contractual, right? So if something fails after a month, you stop, you find someone new. But at least you haven't lost control of your startup. You can continue to pursue that idea. So let's talk about the risk you can control. So a comparison, if a dev shop fails, you're going to lose some cash, but you're going to keep the equity and IP that was built along the path. And you can try again easily. If a co-founder relationship fails, it can get really ugly. You're going to end up divorcing them. This is when lawyers can get involved. There's a lot of fighting back and forth. And meanwhile, your competitors are out shipping and testing ideas, and you're embroiled in this battle over your startup idea. Now you've got a cap table with equity that's burned for a co-founder that didn't work out and isn't going to continue to work with you. So you've lost equity, you've lost momentum, and obviously both of the options have risk. So the question for you is, which risk can you survive? And so let's step back and talk about what are all the options that you have for launch. Because remember, the most important message here is that you want to remain in control of your startup and of the path to get it to launch. So what are the options that you have? So obviously, if you have a best friend who's a potential technical co-founder, that's a great option. And you'll hear a lot of the greatest companies that have been launched are a non-technical co-founder and their friend who's a really good friend who's a technical co-founder who work well together. You've got trust, you've got speed. If that's your situation, that's great, and you should embrace it and run with it. But if that's not the case, then the alternative is to use a studio or development shop to sort of do a cash plan to build it. Now, these can be very cash and equity efficient, right? You're not giving up 40 to 50% of equity. You're giving up maybe some percent of equity to get them aligned with your vision, but it's a much smaller percentage. And from a cash perspective, you can be very efficient with that as well, as long as you keep very tight milestones. The key here is that your goal with a studio or a dev shop is to get leverage, not to just get free labor that doesn't work out in the end. And obviously a third option is low code or vibe code. So if you've got your idea you want to visualize and bring to life, then that's something you can build and start validating yourself to at least start getting some momentum to paint the picture and then to attract the resources that you need to get things moving. But the key here is just get going. Don't wait for that perfect co-founder to come around before you take action. Get going now. The takeaway message here is that be the chef. The startup ecosystem gives you rules to fit the mold. And molds are easy to process at scale. That's the reason why they give you those rules. The rules aren't always there to serve you. And investors don't fund standard cuts. They certainly tell you they want you to be a standard cut because it's a lot more efficient for them to say no to you, and they have to say a lot of no's every year. But that's not really doing you any favors when you line up into that perfect mold. So investors fund asymmetric upside. They're always looking for that one that can give them the 1,000x, 10,000x return. They're looking for that massive idea. So it's up to you to take your idea and turn it into that brilliant idea that's going to create FOMO with investors. And the co-founder trap it's disguised as a rite of passage, right? That this is how you have to think if you're going to be a startup. And if you don't think this way, you're going to fail. But in reality, you don't have to play that game. You can play your own game. So what's your next move? Let me know in the comments what you're working on and how you're approaching the launch game with your startup. And if you want some feedback, feel free to click the link below, and I'm happy to take a look at your launch situation. I hope this was helpful, and please remember to like and subscribe so you can get more content like this in the future. And I look forward to hearing about your startup success soon.